Why good deals still don't raise money. That's the title of this video. But before I start, let me just give you some quick context. I spend most of my time inside real capital raises, working with developers, operators who are actively trying to raise money, not planning to raise money someday. I'm talking about raising money right now. So what I'm about to talk to you about isn't theory. It's not stuff that's been regurgitated out there. It's not coaching advice just being repackaged. This is based on my true experience and the patterns that I see daily. My team and I help sponsors raise money every single day. We know the grind. We know what it means to know what works, what stalls a raise, and what can straight up kill a perfectly good deal. So if you've ever thought that the project that you're working on should be raising faster than it is, then this video will probably resonate with you just a little bit. And just so you understand where I'm coming from, I want to let you know that I've been on both sides of capital raising. I've raised significant amounts of money for founders and sponsors the right way, where some of those companies were quite big and the raises were equally as big. And some of those companies were pretty small as well, actually, but became very big after significant capital was raised. I've seen what happens when structure and incentives break down, which will straight up tank a raise and kill a deal. And even more important than that, I've also seen how badly things can go wrong when there's a bad actor involved. And I'm talking about where a sponsor decides to actually run off with the money that they do raise, and how things can actually implode and crater and the fallout after. I was once charged and indicted for being part of a capital raise where the owner did exactly that. You're on the ship and the captain decides to change course and do something nefarious. If you're already on it, when it sinks, you go down with it. Look, this industry is riddled with red tape, and it's not forgiving if you do make a misstep. So to put it simply, I have a lot of experience in this field. I've done very well, but I've also had some very serious lessons learned too. When capital is raised without discipline and guardrails for any of that kind of stuff, it can fail in more ways than one. And obviously some of those ways can be way more serious and have some massively uncomfortable legal consequences for you. That's why I'm obsessive about how this is done. I've not learned it from theory. So like I said, this is not going to be a regurgitation of surface level content out there that surrounds this subject. You've seen it, I've seen it, just go onto YouTube. This is my highly opinionated advice coming from my direct experience and real life consequences. So with that said, let's get to the topic of this video, which is most of the deals that I see fail to raise capital, but they're not bad deals. And that's the truth of it. There's a plenty of good deals out there that are just not able to raise a penny. And that actually surprises people who are inexperienced in this space. For most deals that don't raise capital successfully, you look at them, they're not bad. They're not scammy. They're not crazy. They're usually solid projects with reasonable returns. They've got decent looking conservative assumptions. They've got capable and experienced operators, but they still flop and either don't raise a penny or they don't raise fast enough and the deal falls apart anyway. They couldn't get enough money through the door quickly enough to actually close on a property or whatever it was. And if you know anything about this business, or if you've at least attempted it once or even been part of a group that's tried to raise money, you'll know exactly what it is that I'm talking about. And honestly, this is the part that most wannabe developers, aspiring investors struggle to understand, because in their head, the logic feels obvious, right? If the deal is good, the money should just follow. But the capital in general doesn't actually work like that. Investors don't work like that. And once you've seen enough raises, both successful ones and the failed ones, you'll realize something that's really uncomfortable, is that good deals fail all the time, and it could be yours. Let's kind of unpack that and go deeper. What do people mean when they say I've got a good deal? That's where you've got to start. Like, what does a good deal actually mean, right? Well, when someone says I've got a good deal, they usually mean either one of four things, a combination of these four things, or all of these four things, right? So number one is it's showing that there's good returns, right? The second thing is that it's in a great location. The third thing is that the pro forma looks solid. And the fourth thing is that the operator has a good track record, lots of experience. Now on the surface, that sounds pretty good. And don't get me wrong, you need all that. Those things they actually matter and you got to have them. But here's the problem. None of those independently or combined will actually guarantee capital being raised. Look, think about it. If returns raised money alone, anybody with a good looking spreadsheet would get funded, right? If you could say, hey, look, this is a 6% pref with a 15% upside or 12% ROI per year on a note or whatever it was, and you could justify it on a spreadsheet, you could expect, or you should expect, people just throw money at you. But it doesn't work like that. If location raised money, investors would just deploy capital wherever there's a major market. They'd just be throwing money in there. As soon as they earn it, they'd deploy it, right? It doesn't work like that. If track record alone raised money, then no experienced sponsor would ever struggle to raise capital. They just go out there, show their resume, here, send some money. But the fact is, you know it like I know it, they do still struggle. They struggle a lot with all those things. They can't really get the money over the line. And the reason for that is not because investors don't fund deals. What they're actually funding is certainty. It's not the deal. Certainty has very little to do with how good a deal looks on paper. Let me explain. Your deal can be technically strong, but it can still feel unsafe to an investor. And when a deal feels unsafe, what do? Well, capital, it simply won't move. The investor's not going to invest. The investor just won't move. That's it. It's that simple. If they don't feel safe, they won't send you any money. And it's not because they're stupid. It's not because they can't read a pitch deck. They can't understand the information. It's not because they don't get it. It's simply because uncertainty has not been removed from the equation. Remember, they're not just buying a high-ticket product here. They're investing hundreds of thousands of dollars, millions of dollars, multiple millions of dollars. And in most cases, post-tax money, this is their life savings. Think about it. You look at $100,000, you've got to have $200,000 pre-tax before you can have $100,000 post-tax, right? Rough estimates here. And look, even if you're looking at pre-tax, we're talking real estate here, even if you've got like a 1031 exchange option, which is a tax deferred option for some people where they can kind of push their tax event into the future. So in this case, it would mean you'd be looking at investors who have pre-tax money. They still want to make sure the structure is correct and that it's in line and compliant with the IRS codes, but they've got to feel certain that they're not going to have an investment that's going to backfire on them. You know, like they don't want your opportunity to trigger an untimely tax event down the road where they're going to get a whole bunch of penalties and be in a bad situation with the IRS. You know, my point here is that there's so much that they're putting on the line if they do not feel 100% certain that this is safe, that the structure is correct, whether it's pre-tax or post-tax money, they're not going to send you a penny. Look, if it's pre-tax, they've got to feel absolutely certain without a shadow of a doubt that you've got a structure that's compliant with IRS codes and it's a compliant tax deferred model that's never going to backfire on them. And I'm saying this because in real estate, there's a lot of these types of opportunities out there. But if it's post-tax, then, which is a lot of cases, you're going to be speaking to people who are post-tax, you want to make sure that they feel certain that what you have to offer provides a safe store of value of their money, because capital preservation is key before capital growth. They won't invest if you can't demonstrate that. If you can't show them, demonstrate that with full certainty that their money is safe. They just won't, regardless of how much potential there is on the upside. It's not because they're stupid. Remember that. It's not because they can't read your pitch deck. It's not because they don't get it or don't understand the fundamentals of your opportunity. It's simply because that uncertainty hasn't been removed. Point blank, period. Now, there's a lot of reasons why uncertainty can show, right? I've maybe alluded to a few there. There's a lot of reasons why you can't give an investor that warm, fuzzy feeling that everything is going to be gravy. You can bring up the top 10 things, 100 things. It's variable. There's so many things that can actually bring up uncertainty. But if we're looking at this assuming that you're in the early stages of raising capital, there are a couple of big reasons that uncertainty will crop up when you have everything else looking good for you. And if you can understand those reasons, you can address them early and you can circumnavigate them. And it's important because I work from the trenches. I work with lots of startup founders or small real estate outfits who want to start raising capital for the first time, or this is their second raise. The first time it was on a promissory note. Now they want to set up a private placement and they want to, take a level up. And this is where I'm going to share the experience, like in terms of what you can do now that will actually move the needle. And so, like I said, this is from real experience, starting a raise from ground zero with your first crappy version of a pitch deck that you probably put together on Canva the night before. This is knowing about what you need to do as far as changing things and positioning yourself from a sales and influence perspective so that you can actually be able to move someone across the line and actually have them deploy capital with you. Not just generate interest, not just get them nodding along, but I mean actually write the check, send it over, wire the money. So the first reason that I'm going to harp on about is narrative. Is no narrative control. I mean, this is the first reason good deals fail, to be honest with you. It's really lack of narrative. And as I alluded to earlier, most developers think that a deal is going to speak for itself. They've picked the property. They've found the location. They've run the numbers. It makes sense. It should be a no-brainer, right? That's not enough. If you don't control the narrative, the investor is going to create one for you. And that's the worst place you can be. And that internal narrative usually sounds like this. What am I missing? Why is this person raising? Why haven't they already been funded? What happens if this goes sideways? In reality, investors do ask these questions sometimes out loud, and the more sensible ones will, but most often these are internal questions that they're trying to find answers to with other questions that they're asking, and they don't actually ever voice them. And if they don't ask those questions, and it's just something that's kind of staying internal, they're like looking for answers without asking those questions directly, then that silence is going to creep in and it's going to absolutely kill your deal and you won't even know why. And if they do ask those questions, so thank God you've got a more sensible investor there, if your answer's flimsy or it's over-explained or you've gotten defensive, you're going to lose control over the conversation. And again, that's when that happens, uncertainty's in, and that's going to take over real fast and your deal's going to tank. You're not going to get the money from them. My point is that even with a great looking deal on paper, you've got to be ready for questions, for those questions, and preempt them and answer them either with logic and rationale, and have those boxes checked. And it's not always something that you have to speak about either. You can kind of set up a situation where they're answered just from like the visual impact of your business. They're getting milestones and replace momentum, movement. And I'm going to share a bit more about how to deal with that in a moment. The second reason is where you have no real distribution. And this is an important one too, because this is all about, again, I just kind of alluded to it, like that sense of momentum, right? This is where people just view you as the person walking around with a tin cup asking people to put money in it. There's a lot of people out there that will say you should start with your personal networks. I mean, that's like the gold standard of advice in this business. Start with your network. Yes, you should start with your personal network because it's low-hanging fruit, but you shouldn't rely on your personal network. Well, it's great when you can get easy, warm introductions from your network and a handful of repeat investors perhaps, and that does work, but it only works until it doesn't, right? The reality is personal networks can and will cap out pretty quick. When they do cap out, what are you going to do? Your momentum is going to die, right? People don't like to hear that, in this business. They don't want to feel like their network isn't worth its weight in gold. Like, you've been in the industry for so long, worked for large corporations, I've got a massive network of investors and partners out there, I should be able to raise capital, no problem. They don't like to hear the fact that their network's going to cap out. But if you've tried to raise capital, even though you've got a Rolodex full of that could translate to hundreds of millions of dollars, as soon as you start calling everyone, it's crickets. No one's helping you, no one's deploying capital, right? You think, it's kind of like a pat on the back, good job, good luck, I'll see you when you've got $100 million deal or something. They don't want to help you on your first go. You think your network's going to support you, and as soon as you try, only a very small portion ever actually get involved. It's like that pity money that comes through the door in the beginning. And I've seen this over and over again, whether it's sponsors saying that they've got a great network, or even it's when hiring sales guys, sales agents out there saying that they've got tons of prior investors on their books, they've got 10 years of relationship that they can leverage. It's the same thing ends up happening. You only get a few people, the lowest hanging fruit, over the line, and after that it kind of slows to a complete halt. And then again, you become that person walking around with the tin cup calling through your Rolodex. And if capital depends on you personally pitching every investor, you don't really have a capital strategy. You're punting. So what you've got in reality, if you're in that situation, is a bottleneck that you've got to fix, and your good deal is probably going to stall. So think about it. If you're going to try and raise 10 million and you call through your Rolodex and you're able to pull in 1.5 million, you're still miles away from your goal. Okay. If your raise is 10 million, you've got like a $20 million property, you need to get the equity portion in, and you can only pull in 1.5, you're not going anywhere. So people have to feel, this is the solution. This is alluding to the solution. People have to feel like the train's in motion. You need to have a machine that can give you a consistent, repeatable exposure to qualified investors so that capital will flow into your deal consistently. And by that, I mean you're able to pull in a couple of million from people in your network, but you're always able to pull in money from a fresh inflow of potential investors. Conversations that you had 3 or 4 weeks ago with people who were thinking about it can now see you making progress, and that momentum will get them on board too. That momentum will create a sense of certainty. You need to be able to create that experience for people, because sometimes it takes 4 to 5 to 6 weeks to get money over the hill. You speak to someone one day, you say, hey, look, we're just starting out, we're looking at our first couple of $100,000 raise. 6 months down the road, you speak to them, yeah, we're up to 10 million, or we're on our second raise, right? You want to be able to show that sense of momentum so that people can get like that sense of certainty, and then they can onboard themselves without even, the conversations become more transactional. So calling through your network with a bit of charisma alone isn't going to do that for you. And by the way, if your network is good enough and you do have the ability to pull all that money in whenever you want, however much you want, then let me be honest with you. Why are you watching this video? You're an anomaly, and we all want to be in your shoes. So that was reason number 2. Reason number 3 is founder-led selling, and where people get this wrong, because this is a yes and a no situation. And the reason I say that is because it's true and it's not true at the same time. Generally speaking, founders being too involved in selling is a red flag, but not always. There's caveats here. Here's why. If a founder or sponsor is literally on every call, taking all inbound inquiries, prospecting, all the cold leads that they have, answering the basic questions, pitching one-to-one, that signals the wrong thing, and it always does. When you do this, you've got no hierarchy. It's completely collapsed. You've removed all seniority out of the operation, and in fact, it makes the operation look small. Investors don't want the impression that the founder's always available. They want the impression that the founder is busy steering the ship and not checking everyone's tickets at the dock, right? The moment it feels, if you invest today, this person's still going to be on the phone with me tomorrow, or is going to be speaking to someone else, you've kind of lost it. That's not the feeling. That's not the sense that you want to give an investor. The dynamic's been shifted at that point, and your deal will lose traction. However, like I said, there's caveats. Founder-led selling or sponsor-led selling does work when the founder is positioned above that process, right? So you've got the sales process, and then you've got kind of the level above it. So not inside the process, but above it. And that's an important distinction here. And by that, let me explain what that means. If you're a founder speaking from stage, as an example, that's different. If you're presenting in a webinar or a seminar and it's a controlled environment, that's completely different. You should do that all day, because there, in that context, it's perceived differently, right? The founder isn't accessible to anyone. You're not defending the deal directly on a one-to-one basis. And it's not really about you justifying capital needs. It's more about you setting the vision and anchoring your credibility and reinforcing the overall authority of the opportunity. What you want to do is have the infrastructure doing the selling for you, the reps doing the prospecting, and the system in place doing the filtering. So that when you, as a founder, show up, you're only showing up once that room is already warm. That webinar has 100+ people on there. That seminar room is already pre-framed. And I can't stress this enough, seriously. This separation matters, because at the end of the day, founders are always going to be emotionally attached to their project. You might have been a great salesperson at one point, but as soon as you become the sponsor, as soon as you become the person with the deal, everything will change, because now you run the business. You're not just selling anymore. You're not raising capital for another company anymore. You are the guy. It's your project, and you will defend it tooth and nail. You're always going to over-explain, you're always going to over-justify, and you're going to defend it. Investors are going to feel that, and if it's on a one-to-one basis, if you're prospecting, if you're calling, if you're doing the sales job, it's not really going to move the needle the way you want it to. It's not going to get investors to deploy capital. That creates uncertainty in investors, because the moment you sound like you need the money, which is what that sounds like to an investor, the deal starts feeling professional, and professional capital expects professional presentation, and you can manufacture that early. So like I said, a good deal doesn't die because it's bad. It can die just because the wrong person was doing the talking at the wrong level in the hierarchy. You've got to kind of create the facade, so whenever you do decide to speak to an investor, it's coming across, or it's being viewed through the correct lens, put it that way. And that leads me to the final reason. Right? And like I said, this isn't the finality of everything. This is just the final of the 4 that I believe are super important when you're just getting started out, because if you get these right, you can move money. And like I said, this is not the actual final reason out of the only 4 potential reasons out there. This is just the final reason I'm sharing with you today that creates uncertainty in investors, stopping them from deploying capital with you and your deal, especially in the very early stages of a capital raise. This is a ground zero cap raise workflow here. And this reason is all about the momentum. Now, you've heard me mention this a couple of times. In fact, all of these points I've mentioned here kind of link into momentum in some way, shape, or form. This is the 4th reason a good deal completely falls or fails. And it's all to do with not signaling proper momentum. You need investors to feel like they're jumping on a train that's already in motion. They can hop on, they can hop off. The train's already in motion. It's already en route to destination. The fact is, investors don't just evaluate the deal that they're looking at, they're watching what other investors are doing, right? They're looking for signals to help with their decision-making process. They're looking for early commitments, right? They're looking for proof of demand. They're looking for clear sequencing. They're looking for a structured raise, and that all creates momentum. And if they don't have any visible momentum, it's going to feel risky, even when it isn't. Right? Remember, they're not evaluating your pitch deck, reading through all your spreadsheets, your pro formas every day, all day long. When they're saying they're thinking about things, what they're doing is they're kind of looking for these signals. And momentum's a big one. If they feel like they're going to miss out, or that this train's moving without them, whether or not they're involved, then they start taking action. Investors don't want to feel like everything depends on them, right? They want to feel like they're joining something that's already in motion. So you've got to create that feeling, and that feeling comes from structure and how you articulate it back to the prospective investor. Think about it. Investors are subconsciously asking, at least initially, before they verbalize it. Like, what's happening after the first call or the second call or closing call? When does capital get deployed? When does my capital get deployed? What's the timeline, right? What's the window that I can get in? What's the deadline? Is there a cutoff period? What are their milestones, right? What should my milestones be? And you don't have to answer these questions explicitly. I'm not telling you to put together an FAQ, although that is helpful sometimes, but you absolutely have to signal these things, that these answers already exist. Give the impression that these questions have already been answered and that you're just part of a sequence. You're one small cog in a very large machine, that there are defined steps, that there are entry points for you and everybody else, and there are cutoff periods, and there are exit and liquidity events. That way nothing feels speculative, right? And as a result, your deal will start to feel like it's positioned correctly to ward off any feelings of uncertainty, because you've created a kind of visible momentum. The idea here is for the investor to not feel like they're deciding whether or not your project is actually gonna go forward. It's actually to get them to feel like they're deciding how they can fit into your project. That's the visible momentum you've got to create. You've got to be able to show that momentum even when you're early stage and you kind of don't have any. I understand this can be hard to do. I'm not telling you to lie either, but you've got to manufacture it. You've got to start with, proper positioning. For example, this is what I mean by manufacture. Obviously, you have to have a clear offer, but you have to have defined milestones, a structured investor entry, real timelines, active movement. Like, something has to be active. There has to be, inspections that are coming on, permits that are becoming available, a legal process that's going through its phases. You can't just have investors say, hey, I can invest maybe at this time, that time. I have a liquidity event in 6 months' time. Can I invest then? You've got to be able to say, no, the deal's not going to be available then. These are your entry points. These are the cutoff points, right? So you have to create some sense of structure with deadlines and milestones in place, because then people will feel like as every day goes by, they're getting closer to that. And once you've got momentum, don't ever let it stall. That's another key point to that, because it rarely comes back. It's really difficult to pick up momentum again. I mean, just from a physics standpoint, that's the whole thing about momentum. It's hard to pick up again, right? And it's true. Think about it. If you've got a raise that drags, like, for example, if you speak to someone 1 month and then you follow up in month 6, not much has happened on your end, right? It doesn't exactly instill a sense of confidence, does it? That's not a place you want to be. That's definitely something you don't want to share. You want to kind of create that sense, well, we've had all these things happen since our last conversation. Are you coming on board yet? Do you want to be part of this crew? I hope that's hitting home. If you pitch a different deal, I mean, think about it. If you called them 6 months later and you said nothing much has happened, that's a bad place to be. If you call them 6 months later and you start pitching a different deal because the first one never closed, again, that's going to be a bad situation for you. You've got to show progression, right? And of course, that's your visible momentum. They're not going to give you the grace of, oh yeah, sure, the market must have changed. What they're really thinking is, well, how good are you as an operator? If you can't make things move, why would I ever risk a penny with you? Remember that investors they're not buying a product. They're investing huge amounts of money and they're expecting a return. This means they're risking a huge amount of money that they've worked really hard for. They want to deploy $5 today and come back a little while later and pick up $10. For them to feel confident that that's going to happen, they're going to want to plug into something that's bigger than them, a system with a lot of moving parts where they're not the only cog that's going to make this thing spin. And by the way, that's an example of why just testing the market, by the way, can be more dangerous than it sounds. I think that's going to be it for this video. Capital raising is not about convincing people your deal is good. It's more about removing uncertainty, ideally before they ask, right? By doing all those things, and you can remove that uncertainty, you're going to find that capital will move. It will move more naturally into your opportunity. And before you go, if any of this is hitting anywhere close to home, there is a video link in the description where I cover how to set up a proper capital raise from ground zero. That's, again, the link is in the description. All right, hope that helped. See you next time.